Every conversation about the most valuable public offering of the decade begins with the same picture: a rocket, a stainless steel stack, venting steam on a Texas launch pad, rising on a pillar of fire. But a rocket is only part of the story. And in June 2026, when SpaceX sold shares to the public for the first time, the part that decided the price was not the rocket at all. This is a story about a company that does three very different things: launches satellites, runs the satellite network, and builds artificial intelligence infrastructure, and about the single balance sheet that holds them all together. The question is not whether SpaceX is the most important industrial company of this century. The filings make a strong case that it is. The question is whether $135 a share pays for the company that exists, or for the company the market hopes will exist by 2030. This is analysis, not advice, and every number here carries a date. Inside the prospectus, SpaceX does not present itself as one business. It reports three: connectivity, space, and artificial intelligence. Each has a different product, a different customer, and a different cost structure, and they are not equally profitable. In fact, only one of them makes money. Connectivity is Starlink, a constellation of more than 10,000 satellites, selling internet access to more than 10 million subscribers across 164 countries. It is the cash engine. Space is the part the public knows: the Falcon rockets, the Dragon capsules, and the Starship program still in development. It carries more than 80% of all payload mass launched to orbit since 2023, and it loses money. The third segment is the youngest and the most expensive. In February 2026, SpaceX consolidated its artificial intelligence affiliate, the platform once called Twitter, and a supercomputer in Memphis called Colossus. That segment burns capital faster than the other two combined. Three businesses, one balance sheet, and the investment case depends entirely on whether the first can keep paying for the other two long enough for them to stand on their own. Difficult to build is not the same as difficult to profit from, and Starlink is where that distinction shows up in the accounts. For the 2025 financial year, the connectivity segment reported revenue of $11.4 billion, 61% of everything SpaceX sold, and an adjusted EBITDA margin of 63%. That is the kind of margin a software company earns, and here it is being earned by a satellite operator. Now set it against the AI segment. In the same year, AI generated $3.2 billion of revenue and spent $12.7 billion on capital equipment, the graphics processors, the buildings, the power. In the first quarter of 2026 alone, it consumed 76% of all the capital the entire company deployed. One segment pays, the other spends, and the spending segment leans on a single contract, a cloud services agreement with Anthropic running through to May 2029, which accounts for most of what the AI segment books as revenue. That is a stable, large cash inflow. It is also a signal. Renting your newest infrastructure to a direct competitor of your own AI model is what a company does when it has more capacity than it can fill on its own. When that contract ends, the AI segment has to stand on its own, against the largest cloud businesses in the world. Taken together, the 2025 accounts show a company growing quickly and spending faster. SpaceX reported consolidated revenue of $18.7 billion for the year, up 33%. The first quarter of 2026 added another $4.7 billion, a 15% increase on the same quarter a year earlier. Growth, however, did not reach the bottom line. The company reported a GAAP net loss of $2.6 billion for the year, and then a further $1.9 billion in the first quarter of 2026 alone. In 3 months, nearly 3/4 of the previous year's entire loss. Adjusted EBITDA was positive, at $6.6 billion for the year, but fell 35% in the quarter as Starship development and data center build-out outran the profits from connectivity. And underneath all of it, capital expenditure reached $20.7 billion in 2025, more than the entire year's revenue. For a company priced as a growth business, that is a striking number, because capital expenditure of that scale is the signature of an infrastructure operator. and infrastructure operators are valued very differently from the ones the market keeps comparing SpaceX to. The headline says growth. The cash flow statement says something closer to a utility, building its network before it can collect the bills. So what does the market make of all this? At the offer price, SpaceX was valued at 94 times EBITDA. To put that in context, the largest software and cloud companies, with established margins and far lighter capital needs, have historically traded in the mid-20s. Satellite and telecom incumbents trade in single digits. The dashboard on screen is a mixture. Some of it is reported results, some is third-party estimate, some is pure scenario. Reverse engineer the price, and the implication is stark. An investor buying at $135 and expecting a 10% annual return needs the company to be worth roughly $2.6 trillion by the end of 2030. At a generous 25 times multiple, that would require over $100 billion of EBITDA in that year. The company reported $6.6 billion in 2025. A high multiple can mean the market has identified a future the rest of us cannot yet see. It can equally mean the market is pricing perfection, and that anything short of perfection is priced as a disappointment. For a company still spending more than it earns, the second reading deserves at least equal weight. No position this valuable goes unchallenged, and in each of its three businesses, SpaceX now faces competitors with real capital behind them. In connectivity, Amazon's Kuiper project, backed by roughly $10 billion and partnerships with Verizon and Vodafone, entered enterprise trials in 2026. It is targeting exactly the high-margin business and aviation customers that fund Starlink's margins today. In launch, Rocket Lab has established itself as the clear number 2, and its acquisition of the Iridium satellite operator gives it a network of its own. Its Neutron rocket is the first credible challenger to the Falcon family at the medium-lift class. Blue Origin, with Bezos' funding and the New Glenn heavy-lift rocket, holds government contracts alongside SpaceX. The United States government has stated repeatedly that it wants redundancy in launch. A customer that insists on redundancy is, by design, a customer that will not let one supplier dominate. And in direct-to-cellular, ASD SpaceMobile is already operating purpose-built satellites of its own, in a market SpaceX is still scaling into. None of this means the lead is gone. All of it means the lead is now contested, and a contested market sets prices differently from an uncontested one. So set the optimistic case against 4 specific pressures. First, the multiple. A valuation of 94 times EBITDA leaves no room for an ordinary quarter. Nothing has to go wrong for the share price to fall by half. The market only has to decide that an infrastructure business should be priced like an infrastructure business. Second, the capital trap. The graphics processors and the data center power and the satellite refresh cycles do not end. They require continuous reinvestment in hardware that becomes obsolete quickly. Profit that has to be reinvested in the next cycle is not profit that reaches a shareholder. Third, the unit economics of the cash engine. The average revenue per Starlink user has fallen from $99 in 2023 to $66 in the first quarter of 2026, as growth moved into lower-income regions. Volume has outrun the decline so far. That cannot be assumed forever, particularly as a funded competitor enters the most profitable segments. Fourth, governance. Through a second class of shares, one person controls roughly 82% of the votes, while holding less than half the economic capital. The consolidation of the loss-making AI affiliate into SpaceX, 4 months before the public offering, is the kind of decision minority shareholders could not block. A premium built on one person's continued presence and judgment is a premium that can reprice in a single news cycle. None of these makes the technology less real. All of them make the investment case conditional. So is SpaceX the company to own for the next decade? It depends entirely on which question you are asking. If the question is which company occupies the physical infrastructure behind the next generation of connectivity, launch and compute, the answer is straightforward. SpaceX has the launch cadence, the satellite constellation, and a partnership position few others can replicate quickly. Those are real assets. If the question is whether that makes the shares a sensible purchase at $135, the answer is far less comfortable. Across 3 scenarios, weighted by probability, the model arrives at a share value around $51 by the end of 2030. That implies a loss of more than 60% from the offer price, and the model assigns a probability above 60% to a loss of at least half. Nothing in that outcome requires the company to fail. It only requires the company to grow well instead of perfectly. The honest version of the thesis fits into a single sentence. SpaceX is the most technologically important industrial company of the century, and its current share price is a wager on flawless execution across 3 businesses at once, not one of which now holds the uncontested position the market is pricing in. That is the story behind the stock. It is also the risk inside the story. This video is education, not investment advice. Every figure carries the date on which it was reported. Check the current filings and market data before you make any decision of your own.